first idea, as advertised, Meg Energy.
So I mentioned to, I think it was Daniel earlier in the show, about waiting for a top pick in the heavy oil space, and this is mine. This is a 110,000 BOE a day heavy oil producer, so we'll call it an intermediate. These are long life, low decline, very scalable assets, easily achievable to double this production base because of the size of the resource. We've owned this for a while now. It's been a very good performer, one of those highly leveraged names to any upside in oil, kind of like an Athabasca, but a much bigger company. It's a pure play, which is why we liked it. There's no dividend, but I do see greater visibility as they meet certain debt targets. I think their goal is to get to 600 million, and then they can increase their return of capital to something closer to 50%, maybe even 75%. And they'll probably do that primarily through buybacks rather than maybe the introduction of a dividend, because there isn't one. So this is one of those rare ones I'll talk about that does not have a base dividend like everything else I'd like to talk about on the show. But it is a very high quality asset. Might be, and it's always rumored to be, an M&A candidate for Suncor, because we know the base mine is coming towards an end, and how do they fill that gap? Obviously Fort Hills and the acquisition recently helps to fill some of it, but all that infrastructure, I think this asset would be prime, because it's 110, and I could easily see it in a larger company's hands over the next 10, 15 years, getting to 300, maybe even 400,000 barrels of production per day.
Okay. Sorry, where could you see it getting to?
I could see it tripling or quadrupling in terms of that asset-based production base.
This is Meg.
This is Meg.
Wow, I didn't know they were that big potentially. Okay, well, here's the company in the news, Teck Resources.
Geez, we can almost take an hour on this one. So I think I came on for a short segment several months ago when they were in the middle of this battle with Glencore, and were they going to be able to execute their own business plan of separating the met coal business and the base metals business run predominantly by copper, or whether Glencore is going to successfully acquire them. And neither one won. Because they were voted down on their proposed split, and Glencore obviously didn't win. They decided to go down the route of, well, maybe we'll sell the business, which is Elk Valley Resources. And they just announced a couple of days that they were going to sell it to Glencore. A little anticlimactic. I think if people always assume there's going to be about $8 billion US, they got $8.6 billion. And probably another $1 billion on top from operating cash flow by the time it closes in the third quarter, they anticipate, of 2024. So kind of in line, but I think this takes a really big overhang off the stock. I know the stock doesn't seem to show that, and we talked off air about, the stock has been weak today in particular, and didn't show much enthusiasm yesterday compared to Glencore's stock being up. Is I think the regulatory hurdles, perhaps the market is concerned. We talked about coal workers and the union asking the BC government to exert significant scrutiny on this transaction.
They're not thrilled about Glencore coming in and slashing and burning, maybe?
Well, look, I'm sure Glencore will say all the right things. I mean, it's not like they decided to enter into this in the last month.
No.
They've been working hard at this, and they have their own game plan of spinning out the coal assets as an entity within their organization. So they're going to say the right things. I'm sure they will appease everyone's concerns. Whether they act upon it over time, who knows, and what kind of strings you can put on this kind of a transaction. But for Teck on its own, as let's call it Teck Metals, which is what they're proposing the name change to be, I think this clears the hurdle, makes it a pure play on base metals, the whole energy transition concept. And the copper outlook is great. QB2 is on track. I know capital has gone up a couple of times, but we could see the goalposts. So the sweet spot is this. They're going to be debt-free, probably $3 billion of cash in the bank, and QB2 will be in full stride by the end of 24 and in free cash flow mode. No new major initiatives for growth probably till 2026. So I kind of think late 24 and 25 will be a sweet spot in terms of return of capital to shareholders and operations really humming in terms of free cash flow.
Yeah, Jefferies, I think it was Jefferies said yesterday that there could be $5 billion in potential returns of capital ultimately.
Look, I look at this thing being probably a $70, $75 stock by early 2025.
I'm not sure if the viewers could hear. They're testing the emergency system there. I turned my smartphone off prior to the show. Denison Mines is your final idea. This would be one of your favorite uranium plays?
Yeah, this one's different. Look, we can always go buy a Cameco if you want the behemoth and the most leverage to uranium prices, but Denison is unique. We talked about E3 lithium earlier, about a new technology that has not been used outside of China. In the case of Denison, they are looking to use in situ recovery methods, which is used in the US, and it's used in Kazakhstan, for example, being the biggest producer of in situ recovery. So it's basically recovering uranium from underground using, again, chemicals and water to bring it up to ground rather than evaporating ponds like you see with lithium in South America. It's interesting because they've done a lot of technical work. I think it's largely de-risked. The technology is well proven globally. And I think this is one where they took an asset that wouldn't have been economic, even I'd say maybe at today's prices for uranium, using conventional technology. This has really brought down the capital requirements, probably $400 million to build this, $420 based on the last feasibility study. Operating costs would be around $16 a pound versus, uranium's around $75 right now in terms of the term market. So very strong economics. The feasibility numbers showed, I think, a 90% IRR, which is quite impressive. So it is almost fully financed because the uranium they have in the ground or the uranium that they own in inventory plus cash, there's probably $50 million that they have to raise. So it's one of my favorite names in terms of leverage to uranium, and I think it's a prime takeout candidate.